The latest GDP numbers are being released in just a few hours. Economic growth has stalled amid a weakening rand, rising debt and unemployment and declining consumer activity. Joining us to explain it all is Sam Rolland from Econometrix. Sam, good morning. Thanks for your time, and you school me on this. Well, let's start first with what figures are you expecting? What are you expecting them to look like later on this morning?
Yeah, thanks for having me on. I think many in the market expect that we are going to avoid a technical recession. I think we will see growth coming out later today. But I think it's going to be extremely weak, and it's going to paint a picture of an economy that really hasn't done much, and a stagnant economy that has yet to escape and realize the ramaphoria that we were hoping to see at the beginning of this year.
Okay, so you say that we would escape it for now, and that seems to be the sort of buzz term around this is for now. What would it take from today? What would it take for us to avoid completely, at some point, slipping into that technical recession? A miracle, other than a miracle.
I think, we need to see investment growing again. Investment growth has been stagnant for too long. And as a result, it limits our ability to produce and expand on our operations. And with that, our output suffers. So to completely avoid a technical recession from a domestic front, remember that a lot of that also has to do with the external factors in the international economy. From a domestic front, we need to start growing again. We need to see manufacturing output rise. We need to see mining. We need to see investment growing. And for that to happen, unfortunately, we need to see greater policy certainty provided by the ruling party. We need to see the issue of land expropriation without compensation. Just recently, Theresa May said that it would be something that can be worked with in the correct economic framework. Well, that's something that's very positive, but we need to then see it dealt with in a very positive manner so that investment can start flowing again, and that's the kind of thing we need to see for growth to happen. And then just from a government side, the risks from state-owned enterprises have placed our credit rating at significant risk of being completely downgraded, and this will be very difficult for us and place us at greater risk of recession. So for this to happen, we need to see the state-owned enterprises also improve their financial health. For us to begin to talk about if we're going to avoid a technical recession at all. So
this latest move of government absorbing the latest fuel price hike, I mean, it may be little, but do you see it having any kind of impact at all on the situation going forward?
I think it's the intention is more noble than what is actually the overall effect. I mean, if you look at what was happening in the petrol price towards the middle of the year, we've already seen a R2 increase per litre in the fuel price. So at this late stage, are we avoiding any pain for the consumer? Well, after a R2 increase, I don't think so. The other difficulty, of course, is there hasn't been any clarity on how this intervention is going to work and how it's going to be funded.
It's a once-off.
It appears to be, because we don't have many strategic fuel reserves left. It appears like we're just kicking the can down the road in this regard and trying to sort of play the market, and that we hopefully will expect the oil price to improve, the rand to strengthen, and the petrol price to come down later on. And I think we're betting heavily against that as government. If this wasn't going to occur and the rand did weaken further, the pain will be worse down the line.
And probably twofold, who knows. But I suppose for anybody who just needs to know what we might have escaped this morning, what is a technical recession? What would happen to us if that were to happen?
So a technical recession is basically 2 consecutive quarters of contractionary growth. Ultimately, it is a name, and it just shows that the economy has, on a quarter-on-quarter basis, so basically in the first quarter, growth was weaker than the fourth quarter of last year. If we enter a technical recession today, it means that growth in the second quarter was worse than the first quarter, which was very poor in itself. So it ultimately also, it is just a phrase, but it still reflects the underlying economy is extremely weak. And rating agencies will look upon this, I would say, quite negatively. Entering a technical recession at this stage, especially when we've just seen state-owned enterprises calling for more government guarantees, the inability to grow and for government to extract more tax revenue is going to really be something that the state-owned enterprises will be concerned about.
And what we're seeing coming from China very quickly for us might make a difference?
Well, I mean, this will take some time to filter through. we
But
ultimately...
the sentiment, like you say again.
Yes.
Yeah.
So in the short term, you might see an increase in sentiment, especially if investment does start to pick up from China. What we need to realize, and we want to see from this investment, is we want to see proper jobs being created. We want to see localization occurring. Yeah. So with investment, it's all good and well, but if skilled labor, if we don't see an increase in the amount of skilled labor or skills development, you don't see the transmission through the domestic economy that you want to see.
Okay, thanks very much for that, Sam. Rolland, let's cross our fingers, because we know anything can happen. We might be in a technical recession. Let's hope those numbers play out the way we're hoping. Thank you very much for that.